First of all, this is Peter Young. I'm head of programs, but before I introduce the panelists, of which I'm one, I'll turn it over to Jeff Kenton, who is the president of Societe this year, and he will give some welcome comments along. Then he'll turn it over to Leslie Waller, who is the president of Racemics, and then we'll start the program. So, Jeff, go ahead.
Thank you, Peter. I appreciate that. Thanks to everyone who could join today. We had over 180 registered potential participants, so really good turnout. And special thanks to to Joe and to Rob and to Peter for hosting the event and making sure that it goes off without a hitch. I look forward to this every year, and this will be the second one and hopefully the last one that we've done virtually. But Racemics and the Societe have had a long-standing history of working together. And this is just an exciting time to kind of look at the industry in overview, and I'm sure we'll get some great input today and have some time for some questions. So I just want to welcome everyone here. And Leslie, if you'd like to say a few words from Racemics.
Yes, thank you. Welcome everybody. I don't actually know, Peter, how many years we've been doing this in a row. I know this is probably the 5th time I've attended a joint Racemics Societe meeting. Do you know the number, Peter?
It's close to 20.
20, okay.
In fact, the first speaker way back when was the Craig Rogerson when he was CEO of Hercules. So that tells you how long ago it was.
Wonderful. Well, I welcome Joseph and Rob. Good to see you again. I wish we could have seen each other in person. And I just want to say a little bit about Racemics and who we are. And then I'll hand it back over to Peter because we're looking forward to a good event today. So Racemics is a nonprofit organization, philanthropic as well, founded in 1952. The Racemics mission is centered around the pursuit of networking, fellowship, education, and philanthropy. Racemics achieves this mission through monthly meetings and scholarships to college students and other educational institutions like the Chemical Education Foundation in support of the chemistry industry. Our membership is made up of 25 sales/marketing and 25 purchasing professionals, hence the name Racemics or mirror image. From all around the US global manufacturing companies. Primarily the people in membership are from the New York metropolitan area, but we do have some people as far as the Carolinas as well as Rhode Island. So there are monthly meetings throughout the year. We have 3 closed meetings each year to conduct Racemics business, and then we have open meetings similar to Societe, and these meetings are open to members and guests and coworkers and customers and supplier for networking. So that, again, I thank you, Peter, for setting this up and inviting us again for the 20+ year in a row, and look forward to the program.
Great. So I am going to just start by saying, before we start, I just want to let you know that the next Societe webcast will be on March 16th, and it will feature that it'll be about the history of vaccines, what have we learned from history, and what's their importance going forward, which obviously is a very timely topic. And we have David Cole, who is the president of Science History Institute, who will be the speaker. So encourage all of you to attend that. I mean, clearly vaccines were, the ugly cousin until suddenly now they realize how effective they are for certain diseases. So I am the head of programs at Societe, but I'm president and CEO of Young & Partners. It's an investment bank focused on chemicals and life sciences. We're actually celebrating our 27th year this year. The nice thing about being the introducer for this is it's actually extremely easy because both Joe Chang and Rob Westervelt are essentially known by everyone in this audience. But both of them have been editor-in-chiefs or global editor in the case of ICIS Chemical Business of the 2 leading senior executive publications globally. So couldn't think of 2 better people to be part of this panel to talk about the industry outcome. What we've decided to do is to use the remaining 55 minutes or so in the following way. Each of us is going to take about 7 or 8 minutes and make some comments. And we're going to go in reverse alphabetical order. And then we will then open it up to discussion amongst the three of us. And then we're going to leave enough time at the end for Q&A so that all of you can ask some questions. And in order to ask questions, all you have to do is just type it in the chat box or the Q&A box, and then all the speakers and panelists will be able to see it. So with that, let's get started. And I'm first, so I'm going to start with a couple of slides. And essentially, I'm going to focus on the outlook, but divide it into a couple of categories: economic, stock market, M&A, and financing. So, I think it's safe to say that the last 2 years have been really quite an adventure for everyone. And the picture was a very positive United States, Europe, and China in 2021 overall. But it has been slipping recently for a variety of reasons, which we all know. And certainly outside of those major regions, the growth has been more challenging, and that'll continue to be the case in 2022. But there are some key things that are really the source of uncertainty. And there are a number of factors: the new virus mutations, the poor vaccination progress in many parts of the world, the higher oil, gas, and coal prices, higher interest rates, which clearly have had it's having an impact, inflation, which is a huge impact on costs, and continued disruptions in the global supply chain and semiconductor supplies. And of course, in certain countries, they're also suffering from labor shortages. So it's a long list. Some of them are temporary, clearly temporary. We're hoping that the coronavirus is temporary, but some of these are going to be longer term and may take some time to be resolved. But the chemical industry overall has done well on a relative basis. I think we're all glad that we're not in the cruise line business or the theater business. But there's no question we still have suffered from many of the factors that I just listed. And on top of that, I think the industry is particularly suffering from ESG issues that have to be dealt with, climate change, carbon neutrality, and the pressure against single-use plastics that have been aimed at the industry. So quite a number of things that deal with. In terms of the stock market outlook, I think the outlook is really depends upon what happens to the overall stock market. The good news is the chemical industry has been in favor for many years and has generally, though, gone with the industrial companies and also with the general stock market. And the stock market has done well, so the chemical industry has done well. However, the future is a little bit cloudy. And it really is going to depend upon how the overall market performs rather than just on the chemical industry. I think things were fantastic until the end of this last year. The markets were going up 20, 28, 22%. Chemical stocks also did quite well. But there's a bit of a cloud, and we all know that January was a tough period for the stock market. And it may or may not be longer term in duration. Certainly some part of the drop is going to be long-term because there's no question that higher interest rates are going to be a factor for a while as the Fed and the European central banks try to deal with inflation. In terms of M&A, last year was kind of an interesting year. It was fairly flat and slow in the first 2 quarters. Then it picked up significantly in the second and the third and fourth quarters. And so we have seen really kind of a year last year that was pretty respectable. Private equity, we think, though, is going to regain some shares. Specialties will continue to surge, and Chinese consolidation will remain slow. But we expect this year to be a very healthy year in terms of M&A. Fortunately for sellers, but maybe not so fortunate for buyers, valuations will continue to be high for both specialty and commodity chemicals. But there are some small signs that their valuations are slipping a little but really from pretty lofty multiples. So what are the themes in 2022? We see at least three. One, divestitures of non-core businesses. Two, acquisitions and divestitures by companies trying to change their overall themes. So, DSM is trying to be out of all basic, chemical businesses, and Lanxess is another example. And the other is there'll be some pickup in private equity acquisitions and divestitures. But those are probably the three primary themes, particularly in the West. Debt financings are pretty straightforward. It's just easy to borrow if you're a chemical company, and that'll continue to be the case. And the volume is really going to be driven by how much money the chemical companies need, because essentially the debt market was happy to provide it whenever we need it. The only reason why it might stay flat or a little bit down is that so much money was raised in 2020 that there's still a lot of liquidity. And last, in terms of equity financing, last year was a very strong year. There were a lot of IPOs and there were a lot of secondary offerings. But with the slip in the stock market in January that may continue for some time, we think that's going to have some impact. However, in terms of IPOs, it's been dominant by Asian companies going public as well as secondary offerings, and that's going to continue with a relatively modest number of Western IPOs. And the last, although there's been a lot of publicity about SPACs, the SPAC companies generally are just not interested in chemicals, so we expect very few, if any, involving chemical companies. So that's our view in terms of the equity markets, debt, M&A, and the stock market, as well as the economic outlook. And now what I'd like to do is turn it over to Rob Westervelt. Rob, go ahead.
Hey everyone, good to be here, and thanks again, Peter, for arranging this. So I'll start here. If you go to the next slide, Peter, taking I guess in one word, you probably sum up the current environment as a disruption. COVID and the pace of recovery, the direction of recovery so far has brought with it some really interesting twists and turns. But demand itself has been pretty resilient since since late 2020. Global output is set to grow GDP 3.8% this year, compared with 5.8% this year. So you see things are still moderating, but where is global chemical output rather set to grow 3.8% this year, compared with 5.8% last year. Things are moderating, but generally above trend. And with the U.S. is a bit of an outlier here, in that output will accelerate this year because of the storms, the winter storms last year around this time in Houston, and the hurricanes in the fall really put a crimp on output. So output should grow 4.3% this year for U.S. chemical makers, compared with 1.4% last year. So on the whole, chemical output, industrial production, GDP are set to grow above trend levels in 2022, but it's not all smooth sailing as we all know. Industry has got to continue to grapple with volatility, the impacts from the COVID-19 pandemic, rising energy and raw material costs, supply chain disruptions, other inflationary pressures, the geopolitical factors such as Ukraine and Russia, all present near-term risks that you all have to manage. And if you look at the supply chain, the disruptions and the delays that have shown up in the PMI data, it's on a scale that's never been recorded in 30 years that this has been tracked. So it doesn't. Things aren't getting worse, but they're not yet improving. So it's an indication that these supply chain disruptions are going to persist, certainly into later 2022. So we're transitioning here from epidemic to endemic, hopefully, but it's going to be continued volatility. And then the second part of my discussion here, I really want to talk about sustainability. I think it's another part of strategy and management that has to be more clearly addressed. And there are risks and opportunities that arise from the energy transition, commitments to end plastic waste, the increasing adoption of ESG standards by companies and investors. And I'll get a bit more into that. If you go to the next slide, Peter. So on the macro outlook, after a 3.4% contraction in GDP in 2020, things recovered 5.6% last year, which is obviously a very nice figure. The expectation is that GDP growth will come in around 4.2% this year and 3.4% next year. So we're seeing growth moderating, but generally stay above the trend of the past 10 years. As I said, some critical supply shortages and shipping bottlenecks are going to persist for the year. Inflation remains high and will probably only subside gradually. That said, inventory restocking should be generally favorable for chemical makers. So even as GDP does start to moderate, there still is a lot of pent-up demand out there, and that should be reflected in strong production output, even as GDP moderates. And go to the next slide here, Peter. So a quick look at the Purchasing Managers Index, which provides a good real-time outlook at conditions and leading indicators. It does show the slowdown that happened at the end of 2021, a pattern that's likely continuing into the early part of this year. The JP Morgan Global Composite Output Index, compiled by IHS Markit, it fell 0.5% in December to 54.3. So anything above 50 is a positive reading. So it is positive, but it does indicate that the growth is moderating. That was led by a deceleration in services. It was probably mostly the result of the Omicron wave, as leisure was one of the hardest hit sectors there. Manufacturing actually continued to increase. But overall, the rates of new orders in manufacturing for export sales and employment did slow, but still remain positive. And I think the one positive for chemicals that comes out of some of the recent PMI reports is what's going on in automotive. In December and January, for the first time since July, production of autos and parts has actually increased for the first time since really the end of last spring. So it does show that supply constraints are starting to ease in automotive, which that's been a challenge for resin suppliers. So that looks like it's starting to ease. And just back to the supply chain constraints, some of the readings of PMI showed that vendor delivery times are continuing to get longer, but the extent of the increases are the smallest since last March. So things, as I'm sure you all know, things aren't yet improving, but they're not getting worse, if that's some small solace for those of you on the procurement side. And it looks like it peaked in October, but the number of companies that are reporting that their own output was constrained by supply shortages has started to fall. It's fallen in December and January. So things are starting to moderate. But and we'll go to the next slide here, Peter. Now, just a quick look at you see global GDP, export growth, and industrial production here. So the chart on the left there, the declines in the financial crisis and relative to what we saw with COVID were actually much sharper, the decline and the initial bounce back. But that said, it looks like that underlying GDP and industrial production are stronger than, or being maintained at a stronger level than they were coming out of the financial crisis. So that's what's driving some of the supply constraints. A lot of attention was paid to some of the malaise that coming out of the financial crisis. Things did seem to, there was growth in the economy, but it was below trend. But thanks to the enormous stimulus that we've seen, that's not the pattern so far in recovery from COVID. So industrial production, GDP, are being maintained at higher levels. And if you go to the next slide, Peter. So I think one of the big trends that I do want to, I'll close on this, is the greater attention and urgency around sustainability issues. If anything, the attention here has increased over the last 2 years, despite what's gone on with COVID. And at Chemical Week, we're working on a tracker of industry commitments that we will publish sometime, hopefully late next month. But roughly, if you back out Chinese companies in our $1 billion club, which is roughly the largest 100 chemical makers, 2/3 have Scope 1 and Scope 2 carbon neutrality or net zero targets. And those really accelerated last year. The pace of those was pretty incredible. But we're already at 2/3 of the largest chemical companies have made firm 2050 commitments for Scope 1 and Scope 2. I think we'll continue to see that more this year. And it's right now skewed to the larger players, but that's going to start to come down the revenue curve as your customers demand it, the big brand owners demand it, and as the regulatory pressures build. So the industry has made really significant commitments to decarbonize its own operation, and will of course play a central role in enabling other industries to meet their own targets as the urgency here does increase and the greater attention to ESG issues intensifies. Also want to note what's going on in plastics, because of course that's high on the agenda here, particularly around circularity issues. Industry has been in support of what looks like it could be a global compact on plastics that is going to be negotiated at the end of this month. The United Nations Environmental Program probably will approve a mandate to start negotiations on a plastics treaty. So it's very early stages here. So there's nothing definite around targets or caps, but it does have the support of industry. So that is one thing to look out for over the next month. And if we go to the last slide, so just a quick recap. So in a nutshell, really chemical demand has been really resilient so far. You're seeing some margin pressure as fourth quarter results come out, but producers so far indicated that they do expect to get price when they can. And thus far, inflation has not things are moderating, but inflation has not really dampened the demand outlook so far. Looks like GDP and demand growth remain above trend, even as they do start to moderate as we get longer into the recovery. The big near-term risks are supply, inflation, geopolitical factors such as Ukraine. And we'll also just reiterate that we do expect sustainability and ESG pressures to continue to increase. And I think it's something to keep an eye out for, regardless of the size of your company. I think increasingly you're going to see carbon and circularity are going to come to define competitive advantage. And I think that's reflected in what you've seen around the announcements over the last year around carbon neutrality targets, advanced recycling. You've seen some really significant, massive investments there, and those will continue. With that, Peter, I'll turn it back to you. Or Joe.
Yeah,
Hey,
let
Joe.
me load Joe's Chang's slides. Hold on.
Great.
Hey, can
Okay,
everyone
thanks.
see the slides? Okay.
Yep.
All right, wonderful. Yeah, thanks. And it's a good place to kind of pick it up here, Rob, from what you were talking about. Yeah, thanks everyone for joining us. That's great. Would like to talk about something really interesting where right now obviously you're seeing high oil prices, and we think that's actually going to accelerate the energy transition, these high oil prices and the pathway to net zero. Right now, the oil companies, they are getting gushers of cash flow, record results in many cases, and they're also allocating substantial portions of their future capex to the energy transition. And that's everything from solar, wind, what's considered renewable energy, hydrogen, biofuels, even electric vehicle batteries and charging stations, along with carbon capture and storage, CCS. We heard from BP recently, and a lot of these are led by the European oil majors. BP's CEO, he calls it performing while transforming, essentially using that strong cash flow from oil and gas to invest in these what they call transition growth businesses. And about 40% of their capex, it's about 15 billion in capex, is going to these transition businesses through 2025. By 2030, you'd imagine about 50% goes there. And you have Shell as well, 35 to 40%. Total, and what they call Total Energies now, the former Total from France, also significant capital expenditures towards renewables and electricity. So as you would wonder, if oil was at $30 a barrel versus $90 today, would they still invest this much money into the energy transition? I think there would be some capex going there, but you wouldn't have this kind of level of capex. Certainly, this is going to increase the level of investment here and the transition itself, rather than going into oil and gas solely. You're going to see greenflation, or you've probably heard about greenflation already in energy. We're seeing some of that now. A lot of that is because there is a renewed focus on capital discipline for a lot of these large publicly traded companies. If you look at 2022 CapEx plans, they're far lower than 2019. So pre-pandemic, they are much lower. They're returning a lot more cash to shareholders. That's become a greater priority. If you look at some of the companies like a Chevron, tremendous cash flow, but less in terms of CapEx. They hiked their dividend, huge new share buyback program. And then among some of the mid-sized companies, still very large companies here in the US, you're seeing variable dividends. They're based on free cash flow or a percentage of free cash flow. Typically about 50%, 40 to 60% of free cash flow will be paid out in dividends. That kind of enforces the capital discipline going forward. These companies want to keep providing dividends to their shareholders, and so they'll be very capital disciplined. Essentially, that capex for traditional oil and gas that's kind of gets crowded out first from the capex going into the energy transition, and then also from the return of cash to shareholders in the form of dividends and stock buybacks. Greenflation will also be in chemicals, so that's also here. It's coming. In the long term, you're going to see higher, more volatile oil and gas prices during this transition. There are high decarbonization costs for chemicals if they want to decarbonize their production and try to get to net zero. And so these capacity expansions, they're going to slow. It's going to be a lot more expensive. And we don't think supply will keep up with demand in many cases. We can go to the next slide. So that's really the key theme for chemicals and plastics. It really is decarbonization in terms of impact on supply and demand. Companies are going to have to invest now to meet these 2030 targets en route to net zero by 2050. The customers are certainly demanding low carbon or zero carbon products as they measure their scope 3 emissions, as well as scope 1 and 2. Investment in scaling up. So, companies are going to invest in existing technologies, some things you can do today, such as hydrogen firing of crackers, electrifying compressors, carbon capture and storage. These are big capital investments, and also in future technologies like electric cracking, or e-cracking, using electricity instead of natural gas to heat up the cracker, and that can be used. That can come from renewables like solar and wind, as well as things like ethane dehydrogenation to get to ethylene. These are much less in terms of carbon emissions. U.S. carbon price would help incentivize some of these investments, as they could sell the carbon credits or differentiate themselves better. And certainly the large chemical companies and even ExxonMobil are in favor of a U.S. carbon price. So we'll see. One really landmark announcement was Dow announcing a net zero carbon emissions cracker. That was last year. And they expect this to start up in Canada by 2027. So this is kind of a blueprint of what some of the new crackers would look like. They chose Canada because Canada does have a carbon price. And very importantly, they have the carbon capture and storage infrastructure. So what Dow is going to do, they're going to convert some of these off gases to hydrogen from the cracker, send it through an autothermal reformer to fuel the cracker, and then capture the carbon and inject it into an existing trunk line in Alberta. The trunk line is already there. Dow is going to also devote a third of its capex going forward. So it's about $1 billion a year to decarbonize its assets, existing assets. So this is a major capital commitment from a chemical company. If you look at ExxonMobil, what they're doing, it's a big proposed project to have a Houston hub for carbon capture and storage, potential $100 billion investment. And this would really benefit the chemical industry. At least 10 companies are interested, including major chemical companies like Dow, LyondellBasell, and INEOS. Just the scale of this project would be 50 million tons a year of CO2 capture by 2030. Just to give a comparison, the largest one in the United States today is in Wyoming, only 7 million tons. So carbon capture and storage, realistically, the only way to get to net zero. So we'll see how those investments plan out. Go to the next slide. Yeah, so what does this all mean for supply and demand? Well, at least on the supply side, you're looking at the last big wave of US, Canada, as well as global polyethylene capacity addition. So this is obviously ethylene from the cracker down to polyethylene. And if you look at that, this year, you're going to have tremendous amount of capacity coming on in the US and Canada, namely the Shell Pennsylvania plant. You've got Bayport Polymers coming on mid-year. You just had ExxonMobil and Savic that's ramping up already. They came on late last year. Maybe Shell gets pushed back to late this year, early 2023. We'll see. But essentially nothing, very little after that in the US. The next one in North America could very well be Dow's cracker in Canada, 2027. There's just no supply coming on since then. And so where are the announcements? I mean, these take 4.5 years to build. So the announcements, it's tough. It's very expensive you're going to have major carbon mitigation measures at these crackers, employ different technologies, even while new technologies are being developed. So this is very costly. You're really getting a slowdown in new expansions. Even if something is announced today, again, when does it come on? Probably 2026, 2027. So yeah, real dearth of supply. Next slide. And also, part of the sustainability theme, the next big thing is the recycling of plastic waste into recycled plastic. So you're seeing a big increase in US capacity, the capacity to process plastic waste. And this is from our recycling supply tracker. And this is for chemical recycling of plastic waste. So this is the capacity that's going to be available. So, we see a big ramp up here. You're seeing companies like ExxonMobil building their first world scale facility in Texas, as well as companies like Honeywell and Vanguard also building chemical recycling facilities. And there was a recent collaboration, it's called the Houston Recycling Collaboration between the city of Houston, LyondellBasell, I believe it was ExxonMobil, yes, and Cyclics, as well as a waste processing facility. And they're all trying to increase the amount of volume of plastic waste. So a lot of these cities and municipalities are going to have to rethink the way, try to maximize the stream of waste plastics to make that available for recycling, and particularly chemical recycling. Last slide. And then Rob touched on this as well. So just shifting to the macro outlook, that is positive, but you're going to see a moderating of growth. So for our senior economist, who used to be the economist of the American Chemistry Council, Kevin Swift, we're looking at 3.7% GDP growth for 2022. That's down, but still relatively healthy growth on a global basis. It's healthy as well. I mean, you do have inflation concerns, supply chain issues, wages not growing in line with inflation. And then, just look at global manufacturing PMIs. They're still relatively healthy. They have been coming down in the US and Eurozone in particular, but still well above the 50 level in terms of expansion. China's always been problematic, and still, regardless of whatever they report for GDP, you look at manufacturing PMI, and that's just kind of bouncing along the bottom. So that's certainly worth watching. A lot of the chemical companies are in terms of demand coming out of Lunar New Year. But overall, it's still a positive backdrop on a macro basis, despite the difficulties and challenges. So thanks so much.
If I just compare the presentations today versus the number of years before, I don't think we've ever had a situation where we've had so many stresses on the companies. Because on top of the normal stresses of running a chemical business, you have all these disruptions related to supply chain, et cetera. And then on top of that, you have the extra burdens of decarbonization, ESG, and so forth. I have to tell you, probably the job of a CEO in the chemical industry has probably never been as stressful or demanding as it is today. I want to we'll get to questions later, but I want to start by sort of posing a question to panelists, which is a lot of these things, a lot of the problem is the transition, right? If you go from one structure to another, often it's the transition that's the real problem. Somebody said, it's bad enough trying to change tires, but if you're changing one tire while you're actually on the highway, and then they ask you to change two other tires at the same time, it's really a problem. And that's sort of the analogy of what the CEOs of chemical companies are going through. So let's focus a little bit. What are some of these unintended consequences that you think will hit the chemical industry? One example being electric vehicles, less gasoline, it changes what the mix in the refineries, it changes what the chemical output is. So it's an unintended consequence, but one that you've got to deal with. So Joe and Rob, any comments on that?
Rob, you want to go first while I think about it?
Yeah, sure.
Tough question.
Yeah.
Yeah.
I mean, it is a tough question, and and you hinted at it in your framing of it. There's just so many variables. I mean, you mentioned what happens to chemical feedstocks if fuels decline, and obviously, I think was it last week or the week before, you saw this announcement from ExxonMobil where they were going to bring together their downstream and their chemical business. And I think part of that, and Karen McKee, the current president of ExxonMobil Chemical, is going to run that business. And chemicals relative to fuels is a small part of ExxonMobil, but they're bringing it together in part because of that challenge. Chemicals is going to take a greater share of the barrel, so to speak, and how do the integrated energy companies respond to that? So that's going to be a big challenge. That has all sorts of implications for feedstocks. The U.S. is probably a bit better positioned because of the reliance on NGLs and has some more flexibility. In Europe, it's going to be a challenge. Naphtha availability, Asia, of course, as well. What happens with naphtha and other things as the fuels mix shifts is a big question. The other thing on the broader ESG concerns, Joe mentioned that the Dow project. You've had some green hydrogen announcements. I think the near term, the emphasis is on sort of greening the fuel and fuel inputs, which is not easy, but relative to like the electrification of a cracker, sort of low hanging fruit. So I think the initial emphasis is going to be on greening the the feedstocks and the energy inputs, but then you get to the tougher challenges around greener manufacturing and processes, and that's probably a decade or more out. So those are some of the challenges that you're going to see. And I'll start with that. And Joe, I'll turn it over to you, and I'll see if I can think of any others.
Yeah, probably the unexpected things. Yeah, I would think that comes on the energy side as you go through this transition. Of course, we remember when crude oil prices went negative, WTI here. It's like, oh, it's an energy transition and less demand, and this is really peak. Oil is peaked already. This is not a viable business anymore. But we saw what happened after that. You still need some of these fuels, and the supply situation, what's happening there in terms of less capex. When you get less capex going in there from multiple parties, that can really have a pronounced impact, especially if any kind of things like weather events, any small disruption can really tighten up markets very quickly. So interesting to see, during what say BP CEO Bernard Looney looked at, by 2030, as the energy transition really has progressed, what are oil prices going to look like? And they have it, I think, just rising slightly at the rate of inflation. And And why is that? You would need much less fuels, right? Well, it all depends on the supply side as well. So it's, yeah, I think that part's going to be really unpredictable. It doesn't mean it's going straight up, but it could get really choppy along the way. And certainly from the gas side, natural gas, it's very much needed during this transition. So you do need CapEx going into that, and you need things like LNG import terminals in certain parts of the world, such as Europe. I think there'll be more, you do need that kind of resilient supply, and even chemical companies, to make your supply chains resilient in the face of unexpected turmoil. That is key among executives.
Yeah, and I make one other comment, which is I think the extent to which you figure this out really varies by company. It depends upon who you serve, what's your chemistry, are you involved with, what parts of the world are you selling into, et cetera. Are semiconductors a big factor? Are electronic vehicles a factor? So, our advice to clients is really, you got to look at your own situation on a case-by-case basis and say, what are all these macro variables that affect me? Because it's very different if you're making surfactants, or if you're making flavors of fragrance, or you're making single-use plastics. It can be very different. So I think part of this is complicated, but part of this is you've really got to look at your own individual situation. I want to turn to another question, which is there hasn't been much comment about China. And I think China is a real dilemma, I think, for the chemical industry. It's like a love-hate relationship. On one hand, you wish you wouldn't have to deal with all the complexities, uncertainties around China and tariffs and so forth. Yet on the other hand, there's such a huge and growing market. So any comments from you, Joe or Rob, about how does the chemical industry have to think about China in terms of the equation, in terms of their business and opportunities?
Yeah, you have to. Yeah, obviously, such an important market. It's a number one importer of chemicals and commodities. So you need to, and the U.S. Is in a big export position for a lot of these materials. So yeah, certainly the health of China's market is so important. And just to track what's going on, one of my colleagues, John Richardson, he produces the ICIS Asian Chemical Connections blog. He does a lot of scenario analysis and just trying to make sense of that market, because there, again, so many variables there in terms of dual control policy, which limiting carbon emissions, energy intensity. They've got a common prosperity movement, which is going to impact things like real estate. You have to deal with that real estate bubble being popped and trying to manage that. It seems very difficult. Just have to watch it carefully, and it's trying to gauge what the demand is going to be. Say for if you look at polyethylene, polypropylene, tough to gauge exactly what that's going to be. Still a big net importer of those polymers and other chemicals, but they're getting more self-sufficient in certain materials, polypropylene in particular, but still trying to build capacity. You just have to watch and see what happens, as they also need to focus on pollution and reducing carbon emissions. So that could potentially slow down some of their capital investments. But yeah, you do have to look at it. And I would just say watch the manufacturing PMI, not the official one, but the Caixin does a general manufacturing PMI to gauge the health, and that's been relatively weak. But it's just hovering around the 50 area.
Yeah, and one of the key things I would add to that is that it's despite those challenges, you have to deal with it. I think it's on a GDP basis, roughly a third of the incremental GDP growth, but for the next 10 years comes out of China alone. It's 50% when you close to 50% when you count to all of Asia. I think for chemicals, it's actually higher. I think BASF had a number that had it approaching 40 or 45%. So all the incremental demand growth from the industry will come from China, and you have to your strategies have to reflect that. That's where the demand is coming from, and even though we're beyond the double-digit growth that we saw through the 2000s, it's China is the engine of growth for the industry, and you just can't ignore that. Not that anyone is, despite the challenges around the changes in China over the last few years around, if you look at what they've done in the tech sector, what they're trying to manage in terms of real estate, it does seem that they're open to multinational investment. You have Exxon going in with a project. BASF has their own project. So it's, they're still looking to encourage investment from from outside the country, which remains from now. But it's China is still the growth engine for the global economy, and particularly for chemicals. That's even more emphasized.
Yeah, and I think you have an enormous problem because China is facing a long list of major structural obstacles. Rob, you mentioned real estate, but look at the list: rapidly aging population, the housing, overheated, housing prices, all sorts of problems that they're dealing with. Now, in the short term, until Xi Jinping goes to the next, party meeting where he's hoping to get elected for a third term. So he's going to try to keep everything fairly stable so he goes in a positive thing. The thing to watch is after that, because there are limits to even a communist country in terms of overcoming huge structural problems and the level of debt, et cetera.
Yeah.
And it's going to be a real test. But for those people who want to say, oh, great, if China, has big problems, so forth, we're better off. But the problem is the economies are now so intertwined. It's really bad news if China fails, right? For all the Western countries because of trade, et cetera. So it's going to be a wild ride in the next couple of years with regard to where China heads and whether it overcomes some of these structural problems.
Yep.
Peter, you're on mute.
We have some really excellent questions from the audience, which just shows you we've attracted some really good people to this event. So I'm just going to go through and answer some, or excuse me, pose some of them. So first one is from Jackie Booth, who says, look, everyone's eyes are on inflation and some level of correction is expected, maybe in the second half of the year. What impact and how big do you expect on the industry and obviously over the long haul?
I'll start with that. I mean, I think I think inflation itself is the bigger risk, I think, for the industry is not inflation itself. It's the potential for a policy mistake in response to it. What could happen as economies start to really take the step off the gas when it comes to policy support. But inflation, companies have, chemical makers have always managed inflation. While CPI this is relatively new. Energy input costs are, these are nothing new to the industry, and they've managed it relatively well so far. You obviously have a bit of a lag, particularly the farther downstream you go, but so far companies for the most part have managed to get prices up by some fairly dramatic increases. You've seen some lag, which has hurt margins, but the expectation is that it will, for the most part, catch up because of the supply constraints. So it's, customers aren't worried about the prices they so much are worried about the ability to supply. From that perspective, I don't think it'll be much of an issue or much of a challenge that can't be handled for the industry. But I think the broader question is what inflation does to the broader economy. If it does, if it does signal some kind of broader downturn in GDP or industrial production, I think that's the greater risk.
Yeah, I would agree with Rob. Joe, any comment?
Yeah, I think you will see some moderation, at least in the short term, as you look early in the year. On the commodity side, a lot of these guys, they were supply constrained because of the winter storm, as well as the hurricanes, weather issues here. But as you look at Q1 and even Q2, the commodity guys are really going to ramp up volumes, and including say ramping up exports where they can, because they're not as constrained. Some of the inventory situations have gotten a little better. But on the specialty side, they're still dealing with the commodity inflation. So they're going to you'll see more price increases, at least from the specialty companies, the coatings manufacturers. They still need to catch up, and they have to hike prices. So you're going to see some inflation pressure there, but at least on the commodity side, that that should begin to moderate. And there's expectations that in terms of supply chain disruptions that have been a big component of inflation, that should start to moderate sometime mid-year. We talked to Chemours recently, and they're dealing with certain things, but yeah, they expect some kind of moderation by mid-year. So yeah, it'll still be a challenge. This is not as transitory as the Fed and a lot of folks would like, but you should see some moderation in the near term as volumes ramp up. Yeah, barring weather events, you know.
So we have a question directed specifically for you, Joe. So Thorin Flint says, question for Joe. Most majors are looking at making big ESG investments in a serious effort to reduce or become net zero carbon emissions. However, each company measures itself on a different baseline. So is there a broader index that measures a key indicator or key indicators of ESG performance by the chemical industry?
Yeah, there's a lot, and I think we covered it in a previous Societe meeting. But there's so many different standards, and you have auditors looking at that, different sustainability ratings itself. I mean, you know, specifically to those commitments on net zero, it is interesting, you know, I think if you look at the big impact the chemical industry has, it's really two fronts. There's such an energy intensive industry, a carbon intensive industry, that the biggest impact you could do is to reduce your own emissions there, as well as produce products that can enable that. But really, if you can reduce your own emissions, what will that look like, and how quickly are you going to commit to do that? 2025, 2030. Obviously, so many companies have announced the 2050 goal. Those are commendable, and you have to have a goal. But if you look at some of the intermediate targets and how ambitious those are, that's where you're going to see the investments that have to go in right now. So I would look to see where companies are committing for 2030, and if they have 2025 commitments. I think Reliance Industries, they have net zero by 2035. That's tremendously ambitious. So that requires a number of structural changes that they're starting to plan for right now. So I think that's really important. And also, you look at CapEx, you have to spend a lot of money to get there. So, are they committing to this? And you can look at their quarterly earnings reports and their presentations and what the CapEx plans are. But a substantial amount of CapEx has to go into this, specifically for those net zero goals and intermediate goals on the route to net zero.
In fact, it's really a bit like a wild, wild west right now, Thorin. I mean, essentially, if you just tried to count the number of entities that are rating companies on ESG, it's just enormous. The criteria are uncertain. It's really a wild, wild west. Now, you would expect some of that in any transition, but it's particularly bad when it comes to ESG. And unfortunately, the chemical industry is learning that it's not just a big company issue. This is affecting small to medium companies as well. I mean, by the way, Societe, we did a compilation of what are the rules, what are the standards and so forth, which is available if you want, on some basis, but just try to help people understand what the lay of the land is. But it is a real problem because it's like someone saying, well, you got to take this class and you've got to get an A, but the problem is I won't tell you what the criteria is for grades. I mean, it's an almost impossible situation. It's going to sort itself out eventually, but in the meantime, it's going to be pretty ugly. And there are a lot of companies who are doing what they call greenwashing, which is, they're kind of manipulating the criteria in a way so that they look good, but the reality is their actual performance is not so good. And that's going to happen for a while. Rob, your comment?
No, I would agree with what you both said. And then Peter, to your last comment there, the idea of if you look at some of the divestments that have been announced with DSM and DuPont and divesting their engineering materials business, some of these companies the more carbon intensive assets are essentially going to be sold. But does that get the industry or society as a whole closer to net zero? Not really. It just pushes those assets into in some cases private hands, which may not feel some near-term pressure. So there's a lot of challenges here that have to be addressed. And back to the original questions around measurements, there aren't today. There are not there's not a single standard, but it's coming. A lot of people are working on it, and it'll be there.
And if I can just add, there's a lot of, customers, they all want to know the carbon footprint of the products and also the plants where it's coming from. Obviously, those products are produced at plants. And I'll just say that, yeah, ICIS, we just have a recent partnership with a company called Carbon Mines to measure some of those on a plant by plant basis. So it's measuring those the carbon emissions by plant. And it's it's quite a challenge, but more and more people are demanding that.
Yeah, there's one question here from Martin Carton. He says, sustainability, industry support excluding China. When will China participate? Will industry become non-competitive versus China if the Chinese don't?
I think China has to, being such a large exporter of goods, the big brand owners are going to want to lower the carbon footprint or have it eventually to net zero for the products that they buy and they sell to their customers. So, where does that product come from? If you want to be competitive, if you want to sell to a Walmart, you're going to have to kind of shift that. And I think that's certainly, it's a good question because you think, oh, China, and what about the Middle East? And, but if you're going to sell into these markets and the brand owners have committed to this and the brand owners have done that because their customers are demanding this, I think that's the way China shifts to. They can make use of these technologies, develop technologies, put investment into the things, and they're investing big into renewable energy at the moment, and they'll simply have to shift towards that if they want to continue to be in that big export position, especially to the big brand owners.
Yeah, I would just add, I mean, Europe's looking at carbon border adjustments, so I think that could be a factor with material inputs. But the question is, what happens in the local China? What happens in the local China market, and does that, if you look at the global ambition to stay within 1.5 or 2 degrees, if China has broadly put out a 2060 target out there. So I mean, I don't think that means things happen 10 years later than they do in the rest of the world. But I think there is a big question about how do you bring China into this. I think part of that is going to be, like Joe mentioned, the consumer pressure. If Hanhai or wants to deal with Apple, or someone wants to deal with a P&G or Unilever, you're going to have to make these adjustments even locally in China. But it's a big question. I don't think it, the question around competitiveness, I think in the domestic markets, it is, as long as within the domestic markets the standards are uniform, I don't think you'll see much of a relative disadvantage for supplying the local markets. But it's a big question as to what China does and how they meet those targets.
Certainly, one of the problems is that they are not doing their part in terms of things like pollution and so forth. I mean, they're actually still building coal-fired electric utilities. And their problem is that the things they would have to do would slow down their economy, and the growth is a huge factor with regard to the Chinese Communist Party maintaining control and power. So it's going to be tough, and it is sad that they keep saying, well, we're just an emerging country. Well, they're the second largest economy in the world. It's kind of hard to call them an emerging country, right? So the last question to wrap up, so we will end on time, is Josh asks a question. Could you kindly comment on the risks to the chemical industry from decarbonization initiatives? And then he goes on to give some examples. So what are the risks to the industry from decarbonization?
Yeah, I'll start. I mean, I think the big risk is the lack of uniform policy support, which will make some of what you outlined, some of the challenges that you outlined there, around the feedstocks. Whereas I think there needs to be greater clarity around defining what net zero means, scope 1, scope 2, scope 3, that everyone is playing by the same rules, everyone is playing by the same standards. But that said, you're going to have to mitigate some of the challenges. The shift to renewables. What does that do for? I know in the example here you mentioned, palm oil, minor metals, even some major metals for EV. How do you address those challenges? It's there are ones that you can foresee, and there are ones that you can't. So you're going to have to be agile. You're going to have to be ready to adapt, and it's going to be a bumpy ride.
Yeah, and I would say that in this area, the Europeans are pushing more aggressively.
Yeah.
And they're going to put in a carbon tax earlier than the US, and the consequences are significant. So that's one of the things you have to look through and look for your company. If they adopt a carbon tax in Europe, then what's the impact on your business, right? And that's going to be critical. Joe, any comments?
Yeah, I think, the companies, they realize what a big risk this is, decarbonization, just because of the capital costs that go into it. So, the big risk is, hey, look, I think the companies may not go forward with some of their projects. I know BASF has a big offshore wind project. They're working with RWE they want to pipe that into their largest chemical complex, Ludwigshafen. But hey, there is a green tax on renewable energy in Germany for the consumers. They're like, look, this may not be economically viable. So you do need some kind of incentive, some kind of push, whether it's a carbon tax or something to do that. And same with ExxonMobil's CCS project, carbon capture. The $100 billion proposed project, is that going to move forward? Without a policy push or a carbon tax, hard to see if it's going to. So they realize how risky this is in terms of just a huge capital investments and what's required to decarbonize. But it doesn't mean the companies can stand still. You have to do what you can. And so Dow's example of committing a third of capex to decarbonizing without any government push at the moment, I think that's a way to go. It should come. There should be pressure for government policy changes, but I think you have to do some kind of investment now. It's just those really big ones, the really big capital projects like the CCS, $100 billion. You're going to need. Yeah, we are paying our bill. Look, we're paying. Okay, yeah. So we that are going to. You need some more clarity on the regulatory front. That's it.
So with that,
Where are the brownouts?
we have run out of time, and we do pride ourselves on starting on time and ending on time. And I want to just say, first of all, thank my co-panelists, Joe and Rob. This has been a lively discussion, and I hope that the audience comes away with a better understanding of what the outlook is for the chemical industry this year and going forward. It is a particularly challenging period because we've never had so many structural, macroeconomic, global political, so forth changes all happening at the same time. But there's no escaping it. And I think the key is to have the right strategy combined with the right financial and shareholder strategy to deal with these things, and just make sure you do your homework. So thank you, all of you who have attended. We have a wonderful group of people attending, and also this is being recorded. So if you want to binge watch like Netflix, you'll have that opportunity, particularly if you're a member. And don't forget, in March we have this wonderful webcast on vaccines and its role going into the future. So thank you all, and thank you, Joe and Rob.
Great. Thanks, everyone.
Thanks, Peter. Take care, Jeff. Thanks.